Well, hello everyone. Thank you for joining us today for Talaria's quarterly webinar, Today's Diversification Problem. Today, Hugh and Lance will discuss the topics from our June quarterly report that came out a few weeks ago. If you didn't receive it, do let us know. We'll happily share it after the session. Microphones and cameras are off. Please submit questions via the Q&A function at any time, and I'll ask them on your behalf during and after the presentation at the end of the two different sections. I'll now hand over to Hugh and Lance.
Thanks, Al. Hugh, welcome to another webinar. They come by quickly.
Indeed.
Now, the topic for today's presentation is around diversification. Before we get stuck right into diversification, I thought for context, perhaps you could share with us the drivers for the investment team publishing and formulating the playbook.
Yeah, hello. Thanks, Lance. Hello to everybody listening, both live, but also if you're listening to this on a recording. Really appreciate your time, of course. So, Lance, we've been writing for at least the last 5 or 6 quarterlies that we are living through a period of a changing monetary regime. And really what we're highlighting is that for the majority of the investment period that allocators of other people's capitals or indeed savers would have been exposed to, you've seen rising nominal cash flow growth and falling cost of finance. And that's best understood as the effects on asset prices because of globalization. The costs of production and the opportunities for growth meant that nominal cash flow growth was higher. And of course, the recycling of that capital and the disinflationary impulse that came out from the production of cheaper goods as the world globalized meant that the cost of finance went down. And in the very simplest sense, if you know the nominal cash flow growth and you know the cost of finance, then you know precisely the price to pay for an asset to generate a particular nominal return. Because those nominal cash flow growths grew faster than one would have anticipated, and because the cost of finance was lower than one would have anticipated on a go-forward basis, that meant that all assets appreciated and did very well. It's our contention now that we're in the process of deglobalization, or effectively really negotiating our way to a new monetary regime. So that's just simply the rules of how we trade globally and also how funding operates globally. And so at its simplest, with the regionalization of the globe that's taking place, trade barriers and the like, we're in a period of a fight for capital. Put very simply, countries and regions will need to be able to fund to a much greater extent their collective desires and policies. And that's most easily understood by rising defense budgets in Europe, in Australia, and around the world. So you're no longer part of this global umbrella. You're now having to provide for that particular good and service on your own behalf. And there's a whole range of things around that. Now, that has a very significant implication for the kinds of assets that will likely do well going forward, and for the assets that people have ended up owning in greater and greater quantities over the last 35 years. So very simply, the playbook is a simplification of how to think about overall portfolio construction and asset allocation in this changing monetary regime. And the 4 that we've highlighted, and we've written about a number of these in quite a lot of detail in each of the quarterlies. And as you say, we're going to come on to this quarter, which we focused on diversification and its importance, is we think that the world got very long duration assets in aggregate. Okay, so that means that a greater proportion of the payback of that asset is further and further into the future. So people are going to have to reallocate capital to shorter duration assets, be that in corporate credit, sovereign credit, if you're going to have any exposure to that, but also within equity markets. That really means that that inflationary environment and range of inflationary outcomes that may be much higher than we've seen going forward is taken into account in portfolio construction. The second key thing that we've highlighted is that in a world where the fight for capital is likely to intensify, predominantly driven by governments, who, of course, particularly in developed markets, are, for all intensive purposes, bankrupt. Governments always get paid. It's going to be increasingly important that the assets of which you're associated or own on behalf of your clients or yourself are self-financing, or much stronger and much less stronger balance sheets, but much less reliant on external funding sources, be that the debt market or the equity market and the like. So that's an important consideration as well, and it will be a competitive strategic advantage for businesses that are able to fund their own capital expenditures, growth, acquisitions, and so on. The third key thing is that real assets relative to paper assets are more likely to play a greater role, and we've highlighted things like infrastructure, so I won't dwell on that. And the fourth key thing is that we are now entering a period where diversification is much more important, because the range of outcomes likely to come to pass is much greater. Very simply put, with a world that's has a much greater level of debt, by definition, leverage works both ways. The range of outcomes is much wider. And of course, I'm sure we're going to touch on it today. We're living through a period currently of tremendous technological change as well, with the rollout and deployment of artificial intelligence. What history tells us is the range of outcomes associated with new technologies for financial assets and markets is very, very wide. So diversification is incredibly important, and that's why in this quarter we focused on that aspect of the playbook in particular.
Great, and I think we will definitely see the outcome from, you mentioned sort of the technology change. Now, of course, thinking about diversification, the quarterly actually articulates it more as a challenge. And actually, one thing I was drawn to was the very first paragraph in the quarterly said that if you shouldn't put all your eggs in one basket, well, of course, as investors, that's somewhat intuitive. The question was, well, what do you do with one basket and one very big egg? So hopefully we can delve into that in a little bit more detail. But taking a step back to a period that arguably, the formation of superannuation in Australia in the early 90s, and this period where a lot of investors have experienced some pretty strong returns. Hugh, what were some of the drivers here? I think I've heard you say before that in the period we're looking at, mid-90s to 2020, it was less about selection and more about participation. So what are the things behind these numbers?
Yeah, what we're trying to make the point here is, like, why are we talking about diversification particularly now?
Yeah.
It's a bedrock of Markowitz's Nobel Prize, and everybody understands that per unit of risk returns are better, generated by having diversified sources of returns. But in that world where cost of finance was falling and nominal cash flow growth was growing faster than would have been anticipated, the key thing was to own assets. And this is really what that slide is showing you. So it's showing you that a whole range of very different asset classes did particularly well. It didn't matter beyond being able to hold your position in the asset. But the crucial thing was to be invested in the greatest quantities that you are able to afford or to tolerate relative to your outgoings and disposable income. And preferably that you would do that with leverage, depending on your risk tolerance, age profile, and the like. But really, we could have been sitting here debating the relative merits in a playbook of, I think REITs are, I've heard REITs are attractive, or I'm going to put my money into Australian housing, or why don't I just get exposure to a global basket of equities or Australian equities? And really, this showed you that the key thing before that was, how is it that you can maximize the amount of dollars that you can invest in the market to participate? And that ultimately was the key thing in terms of the defining feature, despite, very market volatility in some of these assets over a period of time. But point to point, be invested and reap the benefits of compounding as nominal cash flow growth and cost of finance went down, and therefore valuations went up.
Interesting, though, the quarterly also points out that, for an investor thinking about these same historical lessons starting today, the landscape in the mid-90s was very, very different. And there were three things, if I recall. There was Treasury, yields, there was inflation and valuations. How have those three things differed for someone thinking about taking this lesson today versus someone who had started in the mid-90s?
Well, the first thing is that all assets are materially more expensive. Okay. I mean, obviously we're bottom-up, fundamentally driven value investors. We think that the price that you pay for an asset is the crucial thing to both ward against downside. Okay, so ultimately, we're risk managers. Anybody who's running a collection of assets or a portfolio on behalf of clients is a risk manager first and foremost. And one of the greatest defenses against impairment of capital, of course, is starting valuations. So we've come into a world where, as of today, starting valuations across a whole range of asset classes of, Australian property has never been higher, right?
Yeah.
Or maybe it was higher about 3 months ago if you're in Victoria, or just pre the Australian budget. But property is very expensive relative to history and relative to disposable cash flows and incomes. The S&P, a blended ratio of different valuation method multiples, for example, taking a longer term perspective, is pretty much at the all-time highs. So clearly the opportunity and the range of outcomes is much higher when you start from higher starting levels of valuation. From the inflation point that you talked about, as I said, you had this globalization that really drove a disinflationary impulse. Yeah. The cost of producing a T-shirt in real terms has just fallen significantly over the lifetime of that period of globalization, and that's true of a whole range of other products and services. That is, of course, changing as we, become more regionally focused and as supply chains start to recognize that they also need to reshore. So all else equal, if that was to be enacted, and clearly we're seeing policies around the world that are happening, on the margin, that means higher inflation, not lower inflation than we've been used to. And that's not calling the level or where we're going to be in an inflationary period, but on the margin, you are likely to see a reason to expect higher inflation going forward rather than what people have been used to over that period of 1995 to 2020. And of course, yet the duration in asset portfolios has never been higher. So obviously in a higher inflationary environment, you want a faster payback period. Okay, so you want to be reducing your portfolio duration across a whole range of assets. So they're probably the two really big differences. And the third thing is the world has significantly larger level of debt. We've never had as much debt as in the world as we do today. And of course, that means that the range of outcomes is wider, but also the requirement that the obligations are funded to a greater and greater degree by the private sector savings pools to allow governments to be able to deliver or to continue to spend to the level that they've become accustomed. So they're very, very big different backdrops. I think the irony, which you're going to show on the next slide, is, and this is isn't it always the case, when you don't need something as much, it's in greater abundance. That seems to be how things work. When you're desperate for a summer holiday, the chances of getting a sunny week are, diminish. When you've already had a great period of sunshine and then you go on holiday, funnily enough, it doesn't happen. You get a lot of sun. And what you're showing here is that over different periods of time, the amount of the global savings pool that is positively, so statistically significantly positively correlated with the S&P 500 has risen tremendously. So if we were having this conversation in 1995, a little over 20% of the world's assets were statistically significantly positively correlated to the S&P 500. A very different way of saying that is that the opportunities to diversify portfolios was much, much greater. Fast forward to today, and nearly $9 out of every 10 has a statistically significant correlation to the S&P 500.
Yeah, we started off, we mentioned that comment around the one very big egg in the basket. Is the driver, if you're looking at that 2026 year, is the driver solely AI?
I don't think it's solely AI, but clearly that's a tremendous driver in terms of this correlation. We can dig into that in a little bit, I think, when we go through the individual some strategies and different asset classes. But in aggregate, that is true. I mean, if you have a look at different regional equity allocation, so, EM equities, Japanese equities increasingly, I mean, if you're looking at the Japanese market today or over the last month, the US equity market, obviously, so that becomes very correlated with the outcome of AI beneficiaries and enablers. If you have a look also into much harder to, drill through in precise terms, but the direction of travel in things like private equity and private credit is very clear in terms of that correlation to the outcome or likely destination of AI, which is unknown. But the biggest single driver as well, Lance, is that during that period of 1995 up to 2020, is the foundational bedrock of diversification was the 60-40 portfolio. Yes. And if you have a look at the next slide, we're simply making the point with this exhibit is that there was a long period where bonds and equities were positively correlated. Then through this period, ostensibly with globalization, we started to see that correlation collapse and then turn negative. And this became the foundational cornerstone of the 60-40 portfolio. Yes. And since 2020, we've seen that correlation turn positive again. So if I think about diversified portfolios, the very largest traditional way to diversify was to have the 60-40 portfolio. It gave rise to, risk parity strategies and a whole lot of levered bond funds as well. It was predicated on a period, if we were to drill back on this exhibit and show the last 120 years, where more often than not, bonds and equities have been positively correlated. And that has certainly been the case over the last 5 years. And thus, the outcomes associated with that 60-40 big picture diversification simply have not delivered the outcomes that one would have been used to in that period of globalization. So that is really the first very big picture. Partly I love saying it. You've heard me say it before. I've said it probably on every webcast. We continue to see bonds, particularly duration bonds in the government, sovereign bonds, as certificates of confiscation. We would advocate having the lowest level of government securities that one can tolerate from a risk perspective in their portfolio. And many Australian and international investors agree with this explicitly. And of course, that then leads into the question of, well, what is diversification? And what has the landscape been telling us about that change? And that's why we really focused on that question in the quarterly.
Cool. So let's take the last two exhibits we've looked at. So we've looked at mid-90s to the pandemic and then today, noting the increase in correlation. Then we've looked at these points in time. So that 15 years there in grey.
25 years.
25 years. Let's have a look at how each sort of subset has changed and what observations can you kind of share breaking apart those two distinct periods?
Yeah, so, we talk very big picture 60-40. I've said a number of clients that we meet with and people who'd be listening now agree with our view that government securities are not a sensible place to put savings. Yes. Very simply, the US government, for example, is asking to borrow 40 trillion. They're spending 7 trillion a year and they're earning 5 trillion, and yet they want to give you 4.5 or 470 today return for 10 years. I mean, there is no way that mathematically that makes good sense from a cash flow perspective in terms of returning your principal and some. Yes. So a lot of people agree with this. Then you drill down, because this is looking at the different opportunities and, be it asset classes or strategies that can provide that diversification. I think the key thing, if you're listening or for people listening, is to take away from this exhibit is where the dark blue dot has moved further to the right. That is simply saying that the correlation of that asset class or strategy or collection of assets has become increasingly correlated to the S&P 500. And you can see the vast majority of all strategies have become more correlated to the S&P 500. So there's really 2 points I'd highlight here. They're slightly different, but they are important in the nuance. One, we show in the quarterly, and we just showed the exhibit there, $9 out of every 10 across a whole range of different asset classes. So $9 of savings globally have a structure, a real invested interest in what the S&P 500 does. Yep. And yet the S&P 500 today has never been more expensive. And indeed, you've never seen a positive nominal return from today's starting valuation ever. And yet $90 out of 100, even though you think you're diversified, is actually very positively correlated with that outcome. Okay, so that's the first thing. The second key thing, and this is the nuance, is even those strategies that had a statistically significant correlation to the S&P 500. So let me think about long-short strategies, for example, just randomly picking one. Yeah. If we look in that period of 95 to 2020, the correlation to the S&P was about 0.63. That's gone up to about 0.83 today. So not only have the strategies that still had a positive correlation to the S&P retained that correlation has gone up. So that's really an important secondary factor. It's not just that you're in these strategies, but they've got the same correlation, albeit positive. It's that the correlation of those strategies has gone up as well. And that means ultimately that people are far less diversified to a whole range of potential outcomes than perhaps they realize, because they've diversified across strategy types, but not across ultimately the outcomes that are going to drive the returns of those different strategies are very singular. Yeah. And this is your point about AI, and I think I can kind of flesh that out a little bit more here. In terms of AI itself, clearly there is a tremendous transformative technology involved. That is not in dispute. That is very distinct and different from the potential range of outcomes associated with the financial impact on asset prices and the assets that are likely to do well as that really transformative technology is rolled out into society. What history teaches us, railroads, internet and the like, very significant technologies, the automobile, is that the range of possibilities is very wide. The technology transformative impact is not up for debate. The range of outcomes potentially around financial assets, winners, losers, capital destruction, etc., is very, very wide. I think that's intuitive, but what we've been showing is indeed the amount of dollars that is invested suggests a level of certainty that history does not suggest is warranted, given the very wide range of potential outcomes of winners and losers and what the financial market impact is likely to be. So it's not, rule one when you get into financial markets, it's not what people say, it's what they do. So you can talk all day long about the range of potential outcomes and, does Microsoft get their return on investment of 30%, 40%, 20%? Does, so-and-so company who's an enabler continue to be able to compound at, 80% kind of EBIT margins, etc.? But that misses the point. The point is that it's what you do. And in aggregate, what we're showing is that in the way that the S&P is going to be so dictated at the index level by the outcome of those companies and the financial returns they can generate, so too is $9 of every $10 of capital. And this is the imperative thing about looking for diversified sources of return.
And we're going to come on to thinking about diversifiers. Looking at this movement, are there opportunities that are worth highlighting here, almost last snippets of diversification that you would consider calling out?
Yeah, so what we write about in the quarterly is that a whole range of risk premiums, and we've really talked about this for 18 months or so, a whole range of risk premiums are anchored as a spread over a base rate. Okay, so that really is saying the cost of money, and then you're looking for a spread. What's the spread on investment grade credit, junk credit? What's the, many people think about the earnings yield gap between bonds and equities. I don't think that's a sensible way to think about valuation, but a lot of people do. And therefore, this is where the correlations get high. And of course, you should be thinking all of your time about that reference rate. Okay. And that's very hard to predict. And we saw the outcome of that in 22, right? Far more valuable are those strategies at the bottom of the exhibit that we have up at the moment. They are the ones that are decorrelated, or even better, inversely correlated with the outcome of the S&P. So they're the strategies where the blue dot has moved further to the left relative to the teal dot over the period. And there are a number, albeit they only represent less than $10 per $10 per 100. So these are the areas that we would encourage people to be open-minded to allocating into their portfolios when thinking about the overall portfolio level of better absolute returns per unit of risk, right? I mean, that's what we're all trying to maximize. So, for example, volatility strategies at the bottom there have moved from positively correlated about 0.3 to deeply negatively correlated. Trend following remained inversely correlated to the outcome of the S&P, and that has moved more negative. So they're really attractive. Things like merger arbitrage, event, they have also become more attractive. One we haven't got here is, funnily enough, deep value. I don't mean value ETFs, because funnily enough, the value ETF holds, semiconductor companies on 12 times revenues and the like. But true active deep value strategies, I think, are also within this. They've become very deeply negatively correlated. But the thing broadly that we talk about in the quarterly that is common to these strategies, and indeed our second lever of returns, is that they don't rest on a risk premium that's from this reference rate. It's an alternative risk premium. Now, I think it's probably worth unpacking what we mean by alternative risk premium when I say that. An alternative risk premium, in very simple terms, is one that is reliant more on market structure or on behavioral factors. So, merger arbitrage is an understandable way to think about. That's not dependent on left or right, or is inflation high or low. It's dependent on the likelihood or otherwise of a deal ultimately closing. And so you can structure things. The market obviously keeps a discount as companies go through all the regulatory hurdles and agreements and so on that need to happen. And that's why that premium stays there. So that is independent of macro variables. It's simply a function of market structure. Likewise, and of course, we've talked with a number of you about this, volatility, there's a market structure element, but really it's more easier to understand, obviously, the behavioral element in volatility strategies, or the volatility risk premium. That is that people in aggregate are poor at dealing with uncertainty, and therefore they overcompensate to take themselves out of that uncertainty. And they're very poor at pricing the likelihood of a losing $10 versus making $10 event. And therefore they overcompensate because of the discomfort of losing $10 relative to the pleasure derived from making $10. So what a lot of these decorrelated strategies have in common is it's a function of market structure or behavior. And I think that that's really the key point when you're meeting other managers or thinking about strategies that may be appropriate for yourself and your clients when building portfolios. Really think, where can I access those kind of risk premiums, because they are getting increasingly more valuable. In a world where diversification was easy, I could just buy a very cheap bond product, right? If bonds are inversely correlated, and that will give me that diversification. But in a world where there's only 10% of investable assets or invested assets actually have a statistically insignificant or decorrelation point, those can only be getting more valuable. And the excitement that we feel about the strategy that we run on behalf of our clients in that regard.
Agreed. And, if I bring together that kind of high correlation piece, it's a lived experience. If I think about the last 4 drawdown episodes we've had since 2022, it may be hard to see on certain screens, but our old friend, the 60-40 portfolio, sitting firmly in the center of that table. I call back to the quarterly where the reference was made of false friends among private assets and liquid alternatives as a means to protect capital. Is that what we're seeing here?
Yeah, this is the lived experience, isn't it, of what that high correlation means.
Yeah.
And all we've done in the quarterly is show the last 4 significant drawdown periods in the S&P, and you know what it meant is that you didn't get the diversification from capital protection. You know, that's the simple fact. Now, of course, we've had strong rebounds in some of those, you know, those periods. You know, the S&P is not tremendously strong year to date, but we've had some strong rebounds from, you know, the 22 drawdown and so on. But that is predicated on the idea that the next drawdown will see a strong rebound. And what is it if you just simply see a strong drawdown? Not left-hand calamity, you know, markets can go down X emotionally. What happens if you go down 15% and then you just sort of bobble around for a couple of years? And what this shows you is that in the majority of strategies, you will be down significantly. And so the imperative to be able to build portfolios that can protect for a whole range of outcomes or benefit come what may, this just shows you that actually a whole range of strategies are masquerading as providing that, and they simply haven't over the last 4 drawdowns. And you highlighted the 60-40. I mean, it is pretty shocking. We know 22 because that was an inflationary regime and the market was sort of surprised. But even thinking about Liberation Day tariffs, you know, the S&P went down a bit over 18%, but the 60-40 portfolio, you know, you captured pretty much 11% of that. So this is really saying, this is the lived experience of that lack of diversification. And there will come a moment in time in the future, without making any periodization, where the market will go down and it will not have the strong, be that in 5 years, 10 years, 20 years, next month, no one could tell. But that is the impact of having such a correlated portfolio.
Now, Hugh, the investment team, as part of the pre-work, all the thought that goes into the quarterly, actually conducted a bit of an interesting exercise. I reference your earlier comments around genuinely alternative risk premia. Can you maybe take us through what that exercise was, what it considered, and actually what it demonstrated?
Yeah, so what we've done here is we've tried to do a theoretical portfolio of of an Australian investor, or someone on the call today. I take the fact that the Australian equity portfolio here is, say, 40%, might be too high. The point is still the same, right? So we've had a look at these, what we would say, given the correlation work, are not diversifying alternatives. Might be alternative in terms of what they present themselves as, but the outcomes are not lived up to that in terms of actually alternatives. So, private credit, we've used a proxy there, private equity and the like. And we said, well, what happens if you just take that portion and make a modest allocation to true liquid alts that we were talking about? So they're the strategies that we went through in detail at the bottom of the previous exhibit, but 2. And what would the portfolio outcomes be if you just exited those things that are masquerading as diversified with things that are truly diversified? And what is not surprising is, because of what we've shown on that drawdown, the last slide, is that you would have taken a significantly lower maximum drawdown, about half. Okay, that's fair enough. You've taken a significantly lower annualized volatility. Volatility is best understood as the likely path of returns, up or down. What's the variance on that? So a much greater certainty of that return profile. But what was slightly surprising is that actually the annualized return would likely see a pickup. The point, though, is even if you saw a lower return, but the same annualized volatility, drawdowns, and then some more sophisticated risk metrics, is that per unit of risk, building portfolios that are able to access genuine alternative risk premiums or are part of the playbook have generated higher absolute risk-adjusted, much better risk-adjusted returns, and in this case, higher absolute returns. So this isn't coming at a cost, far from it. But even if it was, given today's starting valuations, concentration, I would argue that it is worthwhile foregoing a degree of returns for that higher unit of risk return, given the uncertainty in the destination of where we're currently faced, both in economies and within financial markets.
And of course, the interesting thing that stood out to me was this is a 15% component of the portfolio.
Yeah.
Just a minor change can make some really big differences to a series of outcomes. And this might be a really good opportunity to break for any questions midway through.
Absolutely. Thanks, Lance. So we'll just do a question from James Rees before we head into the second part of today's webinar. James asks, real assets tend to be longer duration assets or interest rate sensitive assets. Infrastructure, real estate, gold all tend to be inversely correlated with interest rates. How do you balance those competing forces? And can you provide some examples of shorter duration real assets?
Yeah, thanks very much, James. Thanks for joining the call and the question. So I think that's a really, when we're talking generalization about an asset class, obviously, it's a big asset class in and of itself. So the funding structure is really important. So clearly what we're talking about here is real assets, the ability to be able to reprice in a nominal world, even though the replacement cost of that asset is just simply going higher and higher. So you're getting a cheaper and cheaper asset relative to the replacement cost. And yet you need a pricing dynamic or a funding dynamic, because you could have a very termed out pricing dynamic where you can benefit from nominal growth. So if you have a look, the gold standard that's always held out is obviously the Toronto Tollway, 50 years, CPI linked, they've got debt and that's termed out that long. So you've got your cost of finance fixed, and yet your nominal cash flow growth can continue to grow. So that would be a good example, even though the duration is relatively long. Remember the thing that, so that would be one example. I think the second key thing that can be really, really negative about infrastructure is that a lot of it is fixed in the ground, right? Yeah. And therefore, governments always get paid. I said this last quarter, but it's just such a striking example. A lot of global energy companies have invested in OECD countries, not least the Northwest Shelf in Australia, because of course it's a lower risk environment, right? And yet actually the North Sea has seen 3 changes to the tax regime since the North Sea came into production. You've never seen a change in the tax regime in places like, Uganda or Nigeria. So even though people put a higher cost of capital on it, once you have Gorgon, 30 billion in the Northwest Shelf in Australia, sunk capital in the ground, if they change the royalty or the tax take kind of situation on that asset, there is simply nothing that Chevron will be able, and its partners will be able to do to be able to take that 30 billion of capital out. So that's a nuance in terms of real assets. And the third key thing in terms of that shorter duration assets, I think things that can actually produce, right? So it's not only infrastructure, but actually produce things, particularly goods, avocados, for example, that can actually rise with nominal growth, right? So the production of all sorts of goods that we need to survive and are in greater demands come off a real asset base that you can protect, but actually the cash flow that can come off that real asset, e.g., land, beef, wool, etc., can actually rise nominally in a higher inflation world. So I think that, agriculture per se is actually a really interesting place as well within that, if you think of infrastructure from a wide perspective.
Gotcha. Terrific. Hey, there is another question from David, but maybe we go to the next section and I'll bring that question back at the end.
Okay, sure.
Sounds good. Thanks, Al. Hugh, just conscious of time, definitely an opportunity for us to dig into portfolio. Yep. Before we do that, of course, for those less familiar with us, we've been privileged for over 20 years now. The strategy has delivered 3 very distinct outcomes. Now, we talk about a high level of income as a component of return, but importantly, and we talked about it earlier, the return source just being so different, relying not just on equity risk premia, but also volatility risk premia.
Yeah, absolutely.
That combined with very healthy downside capture and structurally lower volatility, which ultimately compounds really well, but creates a much smoother journey for investors. With those three outcomes in mind, how does someone almost pick apart the components of return? Where do we see that alternative source of return appearing in these types of breakouts?
Yeah, so what you're looking at here might be easier to say in the middle, the 5-year annualized return. We've just broken the components of return into that retained volatility risk premium, which is at the bottom of the column. Any dividends that do accrue off portfolio companies on behalf of our clients, any interest, because obviously we've got large cash balances backing the commitment that we, depending on the inflation and interest rate environment, we can generate returns on. And then there's the capital component, which is actually the compounding of the equities and securities, direct equities in the portfolio. And I think the key thing I take away here, Lance, or highlight, is the strong, stable nature of that decorrelated sources of return, particularly the bottom column. So we're generating about 600 basis points of return, come what may. And that's predicated, come what may, on the capital component side of equity market side, but also from the volatility side. That's saying volatility stays the same, opportunities don't expand. We stay in a very similar world to today. You're starting with 650 basis points per annum. So the volatility risk premium shows up as that dark, I don't know what color I would describe that as, that dark.
Navy? Navy?
Well, it doesn't quite look navy to me. Anyway, and you can see over the last 12 months that's been about 409 basis points. I think that is really the bedrock of that 8% plus distribution or component of return that makes up those clients that we work on behalf of that take the quarterly distributions. Importantly, the last year was actually higher than that 8.15 5-year average. I think I'd just like to highlight, and this is why I put it on the slide, the underlying portfolio, so the number of shares that we own across a whole range of stocks, the number of, the amount of capital we have commitments to buy a certain number of shares, so that's to access the volatility risk premium, has done extremely well. So the underlying portfolio up just shy of 17%, around 17% over the last year. And of course, those assets are in a whole range of different places in the world. And in the same way that, if you own a banana plantation in Brazil, if the real Aussie changes, you've still got a banana plantation that makes 100 bananas, but the Australian dollar value of that plantation obviously fluctuates with the exchange rate, quite apart from whether the plantation itself in local markets goes up and down. So the currency, just translating that back, has been about an 8% drag, about 800 basis points, purely translation. But why I highlight that is that means that the underlying asset base has both generated very positive returns, but is very much more than intact to be able to generate another year of that 20-year 3 outcomes that we've generated. Excuse me. And that is really the key thing. There has been actually a growth in the asset base to be able to generate future returns consistent with what we've been able to historically generate.
Now, it's not on this chart directly, but that, particularly on the 1-year number, that unusual spread almost in returns between the hedged version of the strategy and the unhedged has produced just some slightly differences in the distribution.
Yeah, exactly. So for those not aware, what that means, of course, is we paid about an 8.25 annualized distribution over the past 12 months on the unhedged version. That's a combination of, as I said, that 600 basis points or thereabouts just comes unrelated to whatever happens to the capital component. And also as we slowly rotate the portfolio, remember 25 to 35 securities, average holding period about 3.5 years. As we rotate into better opportunities, we'll come on to that, Of course, anything that gets washed through, also from an ATO perspective, is paid out. But the key thing there is that for the hedged version, you're just hedging the assets. And so every time the currency moves either against you, you're crystallizing losses, even though the assets are exactly the same, or you're crystallizing gains. And those gains need to be paid out. And that's why you get a less smooth journey in the hedged version from a distribution standpoint, but point to point over 10 years, it tends to be the same. So after a period of time of not paying any distribution in the hedged version, there's been a significant, much larger distribution because of that currency impact, which effectively you're monetizing as the hedges roll off.
And actually,
mechanically, we're not targeting that. That's just that's what the hedging is, and it crystallizes a gain.
Great. And we have produced a bit of a consideration FAQ for people who may be considering one over the other. More than happy to share that after the session. Hey, can we pop the lid on the portfolio? There's obviously a lot here.
Maybe just given such a strong performance of the underlying portfolio over the last 12 months, I'm sort of just conscious of time.
Yeah.
Many people will be cognizant that I love to present the total capital at risk as a single security, like a holding company, and then look at the opportunity set, put everything to 100 in terms of sales, and then we can look pari passu. I think the only thing I'd take to here is, despite generating a 17% return with a, virtually no correlation really to the certainly a negative 0.4 correlation to AI beneficiaries and technology, the portfolio hasn't really got any more expensive. Okay, it's about 11.5 times, about a 40% discount to the opportunity set versus a 17-year discount if we had exactly today's portfolio on a backward-looking basis. That is the key thing I think I'd take away from here. The quality is commensurate. In fact, it's higher when viewed through a returns lens. That's the second groupings from the bottom. And we continue to have a very, very robust balance sheet and self-financing in line with the playbook.
Hugh, you mentioned portfolio turnover and composition a little earlier. Again, just thinking about how this may have changed, or observations that you wouldn't mind putting a little bit more context around.
Yeah, well, the first thing is I'd have a look on the left and say, well, actually, there's no doubt, for better or for worse, we feel very, very good about it, but that the portfolio companies that make up the 10 largest holdings, about 44% of the portfolio, are markedly different to what you would be seeing from a whole range of other managed funds. Okay, this is genuinely different, both in return source, but also the kind of securities that we hold on behalf of our clients and have generated that 17% return. We are structurally, not by design, but structurally underweight momentum, which has been the single biggest factor driving markets and partly why we blend so well with a whole range of people. The second key thing, you can diversify by return type. We've talked really the majority of this webinar about that. You can diversify by region. You have a look at our regional exposure. The S&P or the US assets are comfortably over 70%. We're about a little over 40% in US dollar denominated assets. Not all of those are US companies per se. Europe ex UK, a couple of questions to say on that. That includes Switzerland. You can see Roche is, 4.3 of the portfolio. So I would make the distinction, like with AI, there's a whole range of reasons to be negative on the European Union and the growth outlook as a whole. That is very different to the bottom-up opportunity set individually for the securities. And then the third key thing, I guess, Japan continues to be a market that, stands out in terms of our weighting compared to where it was 3 years ago, which was sort of low double digit. And then just finally, just on the sector, I'm conscious of time, wanted to leave a bit for the questions. Yes. IT, 8%. About 4% of that is really in two mid-single digit rated PE companies. One's a billing software for telecoms, and they do, only work in telecoms, the world's largest telecoms, particularly in the US. Another one is a computer kind of manufacturer, but we have been able to take advantage to about 4% of some ideas that have come through the screen, and we talked about that last quarter. In terms of software companies that have gone, down 60, 70% year to date, virtually none of those are equitized. And indeed, when we sold the puts, and this is to the end of June, the buffer to first loss now, because actually they've been quite good so far in the month, is anywhere between 20 to 35%. So that's been a good place to be. Healthcare remains a significant exposure. That's through the value chain, I would highlight. And financials, just worth reiterating, we don't really have any banks in that 14%. 4 of that is a holding company that's really of industrial assets, and we have reasonable exposure to different parts of the insurance value, insurance industry. So I think that's where I'd leave it.
Great. I might just hand over to Al for questions.
Fantastic. Thank you, team. This one was from David Isaacs, and referring back to the sort of alt portfolio perhaps before. Historically, true alts during periods of market normalcy tend to significantly underperform traditional assets on a relative basis. How would this portfolio, and I think that's the true alts one, have held up over a longer time frame given the last 5 years had a number of volatility events?
Well, thanks very much for the question, David.
Keep going forward. Here we go.
There we are. Well, the first thing I'd say is what we are looking at there in the portfolio is that's from 2012. So, that's from 2020, sorry, this one, but we can do it over a longer time frame. So how has it performed over a longer period of time? That is really a function of actually where the starting period was, right? So obviously, if you started in 2000 at a commensurate valuation today, incredibly well, because the market lost 53% and the S&P 500 didn't reclaim its nominal level until 2013. So I think that's the shorthand, right? The S&P 500 did nothing in nominal terms from 2000 to 2013. Holding anything but that, particularly anything less correlated or decorrelated, therefore has to be better, right? That would be the short answer. But very happy to continue the conversation offline. And certainly, obviously, we have a whole range of factor database. We have a whole range of performance, because you can see that we've sort of shown things back to 1995. So if that's something that you'd be interested in discussing further, we could actually just simply build that over whichever time frame or starting period you wished.
Yeah, terrific. Thank you. Now, we've got 5 minutes to go, just a couple of minutes. Maybe because you've covered a lot today, there's a lot of information, a lot of data and so forth. But if there was one thing you would leave the audience with, what would that be?
Gee, it's hard for any kind of fund manager to just have one thing. So my mind immediately went to 2 things. Examine exposures, not strategies, to get a true sense of how correlated your portfolio investments are, both personally and on behalf of your clients, to what is a very wide range of potential outcomes, exposure to the S&P 500 in particular, but also it'd be easy to construct a AI basket, which is about 60 global securities, to see the correlation of and the factor overlap in your portfolio as a whole. I strongly believe, having put out the quarterly, that the world is far less diversified than it believes itself to be.
Well, that's the takeaway then. Absolutely. We might leave it there. Thank you, everyone, for joining today. A recording of this webinar will be available in the coming days, and as will your CPD accreditation. And we look forward to seeing you next time.
Thank you.
Thanks very much, everybody. All the best.